Are high interest rates slowly killing this property market? As a homeowner trying to sell and get the best price possible, you must be mad like a snake that the Reserve Bank is still holding the official cash rate at 4.35%. Over the past week alone, I've been asked over 20 times what my take on the impact of the property market is. So here's a few clips from a recent interview I've just done. Let's understand why the Reserve Bank even tinkers with the official cash rate, or OCR, in the first place. So it's all to do with inflation that's spiraling a little bit out of control. And when that's gone unnoticed for too long, we see cycles of the OCR getting steadily increased to a point where disposable income of the average punter on the street is reduced to a point they can no longer keep lavishly spending. And so the demand for those goods and services they were consuming, well, that comes down. And when that happens, eventually so do the prices of everything, from luxuries right down to everyday items. It's the age-old economic supply and demand drivers that make the commercial wheel go round. Now, a mortgage at 4.35 would be more affordable, dare I say even very attractive, in today's market of July 2024. But that's not available to us as mere mortals. It's rather the rate the banks lend at. We pay a much higher rate because the banks we lend from need to make a profit for their shareholders. And how do they make their profit? On fees and interest. So if we push fees aside and we just look at interest, they operate on something called NIM, or net interest margin. And when the Reserve Bank ups the OCR by, say, 25 basis points or 0.25%, the ethical banks will pass on that increase directly. But because many can't predict what they'll be borrowing at in the future, they take the opportunity to up their mortgage rates by, say, 50 basis points or more to create more profit certainty. There have now been 5 cycles where the OCR has remained unchanged, and their strong supporters show it's likely to remain the same leading into summer and only start to drop when inflation hits around that 2 to 3% range, which, fingers crossed, circa December or certainly in the new year if the current projections continue. But here's the bad news. Rates seldom come down as fast as they went up, as the government needs to constantly check that inflation is staying within this optimal range. And what do the banks do? Well, they protect their NIM and sometimes delay their mortgage rate reductions because they don't want to be caught out by a reversal either, and in the process snatch up higher profits. For the average punter coming off a 2 or 3 year fixed rate, set much lower in the past, this becomes a little dicey to deal with. When they have to reset their mortgage, this is usually a massive jump in monthly outgoings to stay in home. This is where we start to see distressed sales creeping in, where people can't meet their mortgage repayments, and we're starting to see this happening more and more around the country. And to protect bank profits now that they're facing a bit of risk, it also becomes a bit harder to borrow money, as banks take a far closer look at loan-to-income ratios to protect themselves. They ultimately are bound by regulation to follow responsible lending protocols, so this isn't a bad thing. Now, it's not all doom and gloom, because here on the sunny Gold Coast, we still have more people wanting to come live here than we have homes. So demand still exceeds supply to a point, and that equation generally keeps things a little bit more buoyant. And with the warmer months coming ahead, I think we may just be able to wear these higher interest rates for just a little bit longer than other parts of the country and keep our property market a little bit more stable, but we will need to keep close watch. I'm AJ Hazelhurst, Director and Principal of Status Realty, and I can't wait to meet you and help you realize your real estate dreams.